While many may think that nothing new came out of the Fed, I think this view is very narrow and very single minded focus. Probably only listen to Powell one time. And because we didn't get some sort of screaming change or screaming nuance out of the Fed, there was therefore nothing that came out of the Fed. And because the market had some level of fear that wouldn't happen, or that would happen, that there would be something new, that because that fear is alleviated, the market should rally. And let me tell you, I made a similar mistake last year around May when the market was pricing in some probability that there would be a 75 basis point hike. I felt like, based on what I heard from the Fed, that wasn't going to be the case, and that the Fed was going to do 50. And because that possibility was going to be less hawkish, the market should move higher. So because I'd done so much work listening to all the Fed members and coming to this conclusion, I made very aggressive short-term bets on this. I thought it was a very well-calculated decision. The Fed ended up doing 50. The market ended up being up quite a lot after that Fed meeting for that day in a very aggressive way. I was making tremendous gains in a very fast way. However, overnight, the following day, the market was down even more. It was up over 1% after the Fed. It was down some 2% the following day as the market continued to digest and then just completely shat itself as it was realizing that the Fed wasn't being aggressive enough on the inflation and wasn't going to make progress and was going to let the genie get out of the bottle, so to speak. So, while some people, and I learned a very valuable lesson from that, and I've obviously learned more lessons since, and at some point I will find relevant times to talk about those lessons. But this is what I'm talking about today. That just because the Fed, you're choosing between, delivering something more hawkish or not, that's not going to, in the long run, be what matters. What's going to matter is, what are they doing over the longer run, and what are those effects? And while Powell did not necessarily deliver a Jackson Hole 2022 version, you look at the more nuance that he delivered, and you look at, more importantly, the nuance that the Fed members, both dovish and hawkish, delivered. You view it all holistically, and there are changes to the Fed trajectory and to the Fed dot plot that they even reference changes to the Fed dot plot that are going to be very important and that are currently not priced into this market. And we're seeing some economic stuff that I think right today is being misconstrued. We've seen how today's action is. The market's trying to get a breakout going. It's not. I get it. It's very short term. Believe me, I'm seeing that too. What I'm trying to say is I think the market hasn't finished digesting the Fed and has, more importantly, not fully digested how the economy is actively changing. We've talked a little bit about that in past videos. We're going to talk about it some more today. So first, let's talk about what the other Fed members are saying and what changes actually occurred here. Not only did Fed members speak at Jackson Hole, they actually spoke over the weekend. Fed Mester reiterated her desire and her kind of point here that rate cuts have to be pushed back. The economy has been strong. They're not in a rush to cut rates. Let's not forget, at the beginning of the year, people were saying, the Fed's going to plunge us into a recession. It's going to be severe. They're destroying everything, as they were feeling it in their pocketbooks because stocks were down. The Fed hasn't cut rates. They haven't prompted that recession. Conversely, they aren't feeling the desire to do anything here. Now you might wonder, what if inflation comes down and the economy doesn't feel any pain? Well, you could, in theory, cut rates in that situation, but that doesn't seem to be the approach they're taking. They want absolute conviction, and they are putting it in words. Mester, who is the only one to address rate cuts really in the most direct fashion and is talking about not doing them at all next year. Key point, pretty important thing to consider. is saying that, and other Fed members have said this, not for a while, but they've said this, that the risks of under tightening are greater than the risks of over tightening. That's what they're saying right now. So if the market is playing the assumption of a dovish Fed, of the Fed is done, of that they're going to act with some sort of soft hand, the market and you don't understand what the Fed is trying to do. Don't understand the phases of the economic cycle that are very typical. The Fed typically increases interest rates when we get to late cycle because they want to bring demand down because the economy has gone, it's done well, and it's done too well that it causes inflation. Demand outstrips supply. So they bring demand down. Demand down is not a good thing. It's not like an ideal thing. It's not the Goldilocks environment. You want demand to grow, not for it to come down, not for it to get in line with supply. Maybe supply will pick up in such a way, but we're going to get into the economic stuff in a second. And it's, it's a very confusing picture, and I view confusing as with the economic signs, the delinquency rates, these kinds of things, as pointing to we're in a transition. We're getting the effects of the interest rates. There's still lagged effects. It sounds like there's still at least another hike to come in. So, brace for it is all I'm trying to say. There's also additional liquidity being sucked out of the system every day. Money is literally being shredded. So, what I'm trying to say is we're getting another interest rate hike. We probably aren't going to get rate cuts next year. That's what it's sounding like, particularly if the recession doesn't start anytime soon. So, maybe if there is a recession, maybe we'll get rate cuts. But this is what the market is grappling with. Today, I've noticed this. There's a little bit of bullishness. You saw this in the morning as the 10-year pulled back. Oh, stocks are rippy because we were, led to believe, and rightly so, that higher interest rates are not good for stocks. Well, it's not a perfect correlation, obviously, because if it was a perfect correlation, as we're getting to these multi-year, multi-decade highs on interest rates, stocks should be at new lows, but they're not. So it's not a perfect correlation. You look at China, they're cutting rates. Where's their stock market? It's not a perfect correlation. All else equal, interest rates affect things. But when you bring in economic concerns, when you bring in slower growth, you have concerns. So, Dallas Fed manufacturing survey comes out today, and there are quotes. And Zero Hedge compiled a list of very important quotes. So we're gonna quote a few of these. We're gonna read some, and we're gonna discuss. So, high interest rates are affecting industrial production like never before. Sounds pretty important, right? GDP, industrial production, like never before. High interest rates. In addition to reshoring, heavy activity, supply chain issues, lack of qualified labor, more on that later, and interest rates have placed an inverted incentive to grow due to major slowdown in capital equipment expenditures. This is the time to stop raising interest rates and give confidence to industrial segments to plan growth. They're not going to do that latter part. They're not going to stop hiking interest rates. They're definitely not going to cut them for a while. For a while, the market can project a while as being tomorrow. It is not tomorrow. It sounds like it's at least a year, probably more than a year. It's like a whole different paradigm. The world will look very different in a year than it does today. That I can guarantee. Okay? I can't really guarantee anything else, but the world looking very different in a year from now, I feel pretty confident about that. So, particularly with the lagged effects of interest rates and what we're seeing in this manufacturing survey. We have seen broader markets weaken, with the exception of automotive. We have seen pull forwards from auto, likely due to preparation for the potential UAW, United Auto Workers Union, strikes. Revenues in China are especially weak. For the first time in a long time, we are seeing customers reduce or cancel orders due to softening end-use demand. We expect this trend to continue over the next few months. We continue to make capital investments, focusing on buying high-quality used manufacturing equipment at a discount when other people are pulling back because of uncertainty. The phone is not ringing. Our sales team is working harder with less results. Projects are being postponed, and perhaps, even more telling, payments are increasingly protracted. You add on top of this, manufacturing, the consumer weakness. You listen to basically any company except Nvidia and Microsoft, and you're seeing very clear signs of consumer weakness. You listen to Nordstrom, rising consumer delinquencies, they're hiking expectations of that. You listen to Macy's, same exact thing. You look at auto loan delinquencies, virtually the highest on record among subprime customers. There are signs of consumer weakness. I expect these signs to continue to pick up. I expect these signs without even seeing the evidence of it, with just a massive raise in interest rates. This is what the Fed expected. They expected some of this. Some of this was needed. The economy was too hot. There was too much leverage. There was too many people buying Lamborghinis on 3% interest, making $75K a year, 85, whatever the number is they needed to minimum qualify for that loan because the interest rate was so low. And money was plentiful, and banks, nobody was taking loans on the business side, so they had to do the consumer stuff. And look where they are now. So there's a drainage that needs to happen. There's a deleveraging that needs to happen that is currently happening. And we should expect it to continue. And the demand being above supply, growth being above potential, causing inflation, is now going to come down a little bit to bring the economy back into balance. We had a very short-term period of amazingness, and we need to have it's just natural to have a less credit available period. The period is not sustainable. Debt creates cycles. If you don't fully comprehend this concept, that's okay. Watch this video called How the Economic Machine Works by Ray Dalio. Look it up on YouTube, How the Economic Machine Works in 30 minutes. It will explain this idea to you in very clear and simple and animated terms. So, that's today's video, and until next time, peace out.